Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books. Today we're talking about why the stock price for Warner Brothers Discovery is so low. It is a great company. They're doing great things. Why is it off 50% from the price from the merger just from April 2022? It's a good question. People ask me, and why do they ask me? Because I'm Adam Post, and I've done like 45 videos about Warner Brothers Discovery in the last 6 weeks or so. I'm covering everything about how they're not trying to sell the company. They're a focused management team. They're just concerned about money, and they're concerned about protecting the brands. I did predict a year before the company was spun off, maybe longer than that they were going to spin off the company from AT&T. Other people did as well. It wasn't just me, but you can kind of see these things if you pay attention and you have some familiarity with these businesses, which I do. So we're going to talk about it, why the stock is so low. There are good reasons. There's an article I like a lot from Seeking Alpha that talks about the basics. They go into some more details. We're not going to cover every detail because we'd be here for hours, but we can cover the main ones. And I think you'll see at least this is a good understanding for why the stock is low where it's at, and then maybe gives you a sense of like when the company might start to do better and have the stock price reflect the business opportunity they have. Again, I'm doing this because I see it in the comments. I see people talking about buying the stock. This is not investment advice. My videos are because I'm passionate about the subject. I'm really, really happy to see that there are serious business people in charge of very important entertainment properties, which also include comic books, which I am very passionate about. And they're focused on doing good content. It doesn't mean we're going to love every single thing that they do. It means they are not out to take brands and properties and destroy heroes for some sort of a social justice purpose like is going on overtly, just completely out of the open at other companies. It's not going to happen at Warner Brothers Discovery. Absolutely happy to tell you that all day long. Love to see what your comments as well are in the comments section below. All right, let's get into the article. Before we do, please do subscribe to the channel. Click a bell for notifications. Give me a thumbs up, and let's get into it. You guys have been amazing. The channel's growing. It lets me do more and more of these videos, so I appreciate that. Warner Brothers Discovery, negative sentiment is overblown. So Seeking Alpha is a finance website. They have some clever analysis. You don't have to agree with all of it. I don't agree with all of it. But this article really from Panther Research does a great job. So the two biggest concerns about Warner Brothers Discovery aren't very serious. The declining cable business is not as bad as it seems because they are a big cable player. Warner Media was, Discovery absolutely was. And together, they have a lot of cable business going. But as we'll see, the declining of the cable business, the cord cutting, and the fact that people aren't as into the cable channels as they used to be with subscribing to those, it's okay because the streaming services that they're in, and they're a very substantial player in streaming services with Discovery combined with HBO Max, not even when they combine the app, just as they are today, they have like 92 million actual paid subscribers. It's a lot of money. And the streaming services are actually growing more than the decline of the cable channels. You see, so even if the cable channels are like a melting ice cube, they've got these brand new ice cubes that are coming in, and that's the form of the streaming services. Also, the huge debt load is actually manageable. I'm the only person, in addition to this person, Panther Research, who wrote this, who seemed to acknowledge that in April of 2022, they had $58 billion in debt at the company. $58 billion is a lot. They could afford it. They were able to have it. $15 billion came from Discovery. $43 billion came from special financing they had to raise to acquire and merge in a Warner Media. However, they could handle it. But just since August of 2022, they paid down $6 billion in debt off of the principal. Paid it down. That's not bad. That's more than 10% of their debt. That's good. That's a plus. But even in articles still published today, they don't acknowledge that they paid that debt down, particularly in media articles from places like Business Insider, Hollywood Reporter. They keep mentioning $58 billion in debt, $58 billion. They know it's not $58 billion in debt. It was announced in June through their public conference call that they plan to pay down $6 billion in debt by the end of August. just it publicly stated. I have it. I have the recording. You can look it up on YouTube. They're just, and they actually paid it. It gets ignored because there's an agenda, because their agenda is business and money, not social justice. So they've got enemies everywhere. I know how that can be. Warner Brothers Discovery stock price currently trades at $13.20. Now, that $13.20, unfortunately, now is $12.02. It's lower. That's life. And it is trading down from the merger price, and there are reasons for it. We're going to go into why. And some reasons for the massive decline. Okay, these are the major reasons for the massive decline. I've said this often. I'm going to say it again, and I'm going to say it a little extra this time. The number one reason the price is down is because literally 71% of the shareholders of this company had the shares dumped on them like an inheritance. As if you had an uncle who lived in Costa Rica who owned 7,100 houses out of 10,000 houses, and all of a sudden he passed away. You didn't even know you had that uncle. And you get a phone call from an attorney saying, hey, I have incredible news for you. You now own 7,100 houses in Costa Rica. And you're like, well, I mean, that's great. Can I sell them? Because I don't go to Costa Rica. I've heard it's beautiful, by the way. I have a friend that lives there. But, you know, no, I would, of course you're going to sell the house. But what happens if you sell 7,100 houses, or a large portion of them, 1,000 of them, 500 of them, 2,000 of them, out of a neighborhood of 10,000 houses? What happens to the price? Supply is up, the price goes down. Why do AT&T shareholders have 71% of the stock of Warner Brothers Discovery? How did that happen? Did they not see this coming? Of course they saw it coming. They did it because it was a tax, not evasion, that's illegal, tax efficient avoidance strategy. Those two things apparently are legal. By the way, I'm not your accountant, and again, this isn't investment advice. They executed what's called a reverse Morris trust. It's a fancy business thing that allows you, if you're a big company, to take your company, take a piece of your company and give it to your shareholders, and no one has to pay taxes on that giving away, that distribution, the inheritance to the shareholders. Now, do the shareholders have to pay taxes on that? I can't get into that with you right now, and I don't want to get involved with giving more tax advice. That said, AT&T was able to get the transaction done and get debt cash that was raised by the Discovery side for the merger for Warner Bros. Discovery. They were able to give that to AT&T. AT&T has been able to, in my opinion only, completely obfuscate and hide their losses in this transaction. I think Warner Media cost AT&T billions. It's disputed. Certainly the CEO of AT&T, John Stankey, disputes that. But I really believe they've lost billions in this transaction. And they lost, it's indisputable, like $50 billion on the DirecTV deal. That was a separate deal from this altogether. AT&T just made a big mess of all their media deals. That said, the reason AT&T shareholders have it is to make this merger happen. AT&T had to give to their shareholders all of their ownership in AT&T. They did that by saying, okay, if you own AT&T stock, 0.24 shares, approximately 25, 0.25, 0.24, a quarter of every share you own. So if you own 10,000 shares of AT&T, for free, you're going to get 2,400 shares of Warner Brothers Discovery, which even at a $30 value, you do the math, it adds up and it's cash money. But the AT&T shareholders never went out to buy Warner Brothers Discovery stock. Warner Brothers Discovery is not pumping out dividends and profit sharing the way that AT&T does. These guys, they're not interested in Warner Brothers Discovery shares. They never wanted the houses in Costa Rica. They bought AT&T for the very steady dividends that they're supposed to be paying, which incidentally had to be cut after this deal because AT&T just completely messed up their finances on these media mergers and acquisitions. And I can tell you as an AT&T customer myself personally they've been raising my prices. I mean, like every month it goes up a couple of pennies. The other month it went up like $6 or $7, whatever it was. They keep raising prices to generate extra cash, and they get away with it. I'm not canceling my service. You know, it is what it is. But in any case, that's why that number one reason is really there, why the stock is so low, because 71% of the people that own the stock never bought it. It was just thrown at them like a gift that nobody wants at Christmas. Well, what happens to those gifts? They get stuck in a closet, they get thrown away, they get returned. No one's buying and holding that. They didn't even buy it, so why would they hold it? I know what I'm talking about. I've done like 45 of these videos now, okay? So that's why the number one reason is that the stock is down. Number two, Netflix blew itself up. I never understood why people thought Netflix was so amazing. Yes, they were growing and they had profit. A lot of that kind of stuff can be, let's just say, massaged with accounting numbers as well. You know, big companies have the ability to do a lot of what they want to do on their own with their tax information and their income information. And Netflix was growing and it was working, but it's just one distribution channel. Now there's so much competition in streaming, which is reason number three, that Netflix has lost 200,000 subscribers in the first quarter of this year, and they were projecting that they were going to lose another million or so in the second quarter of this year. That blew up the streaming industry. So with all of that, people were not so excited to go and buy more Warner Brothers Discovery stock, which the deal closed for in the second quarter, after this Netflix stuff in the first quarter. It's almost funny, like Netflix did this to sink the industry before the Warner Brothers Discovery merger. They may have blown up the merger over something like this. Thankfully, they did not. Number three, strong competition in the streaming space. We just spoke about that. A lot of people doing streaming services. Four, a high level of debt compared to their peers. So other companies have debt, but not quite as much compared to Warner Brothers Discovery. Messy post-merger operations, which is no negative reflection on the Zaslav team. It's just that's the nature of a merger. Go and move into a house. You ever move into a new house? You have to unpack all your stuff, put it all away. It takes a year. I moved 5 years ago. I still have stuff I haven't unboxed since I moved. I'm sure you're the same. I know how you get sometimes. Number six, a lousy macroeconomic outlook. Well, yeah, there's a recession. That's not helping anybody. The recession looks like it's going to get worse. Inflation is horrendous. Do you need another streaming service? Yes, some people. No, not others. Recessions screw up the business environment for all companies. Stocks are doing badly. I just heard today someone was just mentioning on one of the business channels, there's like $10 trillion in value lost in stocks over the last year. I'm sure it's affected all of you if you have any stocks. All right, so this article, and I'm going to give you a link to this article because it's very thorough and very well done, covers many specific details with really good citations. Numbers don't lie, people lie, but numbers don't lie. If you look at all the math, you can kind of you can understand all of it. But the two factors that this guy is analyzing the most are the declining cable business and the huge debt load. With respect to the declining cable business, basically they explain that yes, while there's a lot of people doing cord cutting, and while a lot of young people, you young people, do not sign up for cable, some still do. A lot of people still do have cable subscriptions. And even though you can see this revenue here, even though cable subscriptions are declining, and this goes back from 2016 over here to what they project for 2026, from a high of 108 billion spent on cable revenues for subscriptions in 2016. From 2026, they expect it to be 70 billion. Basically, the bottom line is with these charts that the streaming services, which started out at like, 11 billion in 2016, are projected to be up to 93 billion by 2026. What does that mean? What that means is, it's very simple, and this chart explains it all, and this guy does a great job with all sorts of details. Streaming services revenue is increasing more than the decline of cable revenue. How crazy is that? And what's more is if you are running your streaming business efficiently, these guys are crazy efficient. They are incredibly efficient and very cost and profit focused. Every dollar they get from streaming revenue is very valuable to them because it's not, licensed through a cable operator. They're getting to keep it. It's direct to consumer sales. So there's no big discount on the revenue they're getting. Past break even, I don't want to tell you I don't want to tell you the wrong thing. It's expected that within a year approximately or so, Warner Brothers Discovery should be break even on profit loss on their streaming versus the direct to consumer revenue they get for it. But every additional dollar they get past break even, like 50% of it, 50 cents on the dollar is going to be pure profit for these guys. It's amazing. And they are growing. I think they need to get to a roughly 130 million subscribers. When you're looking for citations, I'm just telling you stuff off the top of my head. I know the numbers work. I'm going to give you a link to this article so you can look for yourself and see all of these specific statistics. There's another major issue, and this guy makes a great point with it, which is this, that many people who subscribe to streaming services actually don't cut their cords either. So like I have a streaming service. I have 2 streaming services that I subscribe to right now. But in addition to that, I also have cable I'm paying for. So his point is like, look, even though you're seeing growth from streaming and you're seeing decline in cable, the cable is going to level off unless everyone cancels all of their cable, which we're not doing yet. That's a big deal. So the author points out that you can get double the revenue, not necessarily 2 times the revenue, but they can get revenue out of me from a streaming service, and they can get revenue out of me from a cable service. A damn good point. Their debt is manageable. Now, the author here might have more accurate numbers than I do. It's very possible. I mean, they did a very thorough analysis. I'm saying, just to be conservative, that their debt that they paid down, $6 billion in debt from $58 billion, which would leave them with $52 billion in debt. They say that right now it's approximately $47 billion. I don't know. It could be 52, it could be 47. They need to be more accurate than I do for their line of work. So I'm going to say they're probably right, but I'm more comfortable just saying the debt is, they at least paid down $6 billion in debt, if not more. So because they do have a large amount of debt, even if it is $47 billion, you can look here at this chart. It's a beautiful chart. Warner Brothers Discovery has a market capitalization, which is the value of all their stock if you sold it tomorrow, of $35 billion, and a total debt of $47 billion, with $8 billion in cash on hand. Netflix has a $98 billion market cap with only $17 billion in debt and $6 billion on hand. Disney has $190 billion valuation worth of stock with only $58 billion and $15 billion on cash on hand. Very good for Disney right now. And Paramount has $16 billion in stock market value, $20 billion in debt, and $6 billion in cash on hand. So yes, the debt is a bit high. And yes, when your debt is running a bit high, it does punish your stock. Not nearly as much as reason number 1, all of these AT&T shareholders that inherited 71% of the company. That is so unheard of as to be the point of almost completely ridiculous. The guys who organized this transaction knew, John Malone has said since the merger came out that he knew the stock price was going to get beaten up. John Malone is they call him a cable cowboy. He's a guy that really helped build the whole cable industry from the 1980s on, a mentor to David Zaslav, and still on the board of Warner Brothers Discovery, and a gigantic stockholder. He even bought more stock when the deal was done, apparently. So according to management's presentation, only 29%, this is the other issue to really know about. Only 29% of the total debt, or $13.6 billion, is due within the next 3 years. So they only have $3.6 billion due in the next 3 years. The average maturity of the debt is 14 years, meaning they don't have to pay off the debt, the principal amount, for 14 years. The average cost of the debt is 4.3% of interest. That's the interest they're paying, which is good. Fortunately, 87% of the debt is fixed and 13% is variable, meaning 87% of the debt is at this 4.3 interest rate, which is a low interest rate. And they've got charts of when the debt comes due. And this is good to be aware of. This is good to know. Just to look at it and realize the problem with them having a lot of debt is only for two reasons. One, they can't afford to pay the interest. Or two, they can't afford to pay the debt that they owe. Like if you can't afford to pay the credit card interest, the minimum payment every month, that's a problem. If you can't afford to pay off the debt eventually, that's another big problem. It can be devastating. But they're not at all in that position. Their interest rates are low, 4.3% for the most part, and 87%, which is practically all of it, is fixed. And it looks like they're not going to need to even refinance their debt. A lot of these companies, these heavily leveraged companies where they have a lot of debt, and they do that so they can have a higher return on investment. So if it took, let's say, $100 billion to run the company, and they had to raise $100 billion in what you call equity, then you have to get a return on investment of that $100 billion. The profit has to be significant enough that it's worth tying up $100 billion. If they have $50 billion in debt, you only have to raise $50 billion and pay the interest on the other $50 billion. So it gives them more of a return on investment to have more debt. That's why these kind of companies do this sort of thing. In this case, you almost have to wonder, like, exactly what were they thinking and why were they doing this? I think they were thinking that a lot of their friends, honestly, nothing wrong with this, but a lot of the people that believed in the company were going to be making significant investments in the company at a very low price, because obviously these AT&T shareholders were never going to hold on to this stock. They were never in the market for it. They got it for nothing. So the only way for them to get value out of it is either to hold on to it for the future or sell it immediately for cash. So that's what's been happening. People are selling it. It's like a steal. They're selling it for practically nothing. So they have more than enough. Bottom line, I'm going to give you a link to all this. There's more than enough money coming in, and you can look at all the specific charts and numbers if you want to just see where they're all at with the years that debt is due and all this. They have more than enough money coming in to pay for all of this. They're not under pressure to refinance any of this debt. None of the debt is past due. They're well aware that they have large amounts of debt. And they're also very sharp and conservative people. And if they were at any consideration or any kind of concern about, oh, do we have enough money to pay this debt, to pay the interest, they would address it. And by the way, one of the ways you would know they were addressing it would be they would pick something and sell it for cash and then use that to pay down debt. What would they sell for cash? I don't know. I don't know like what their whole portfolio is. Maybe they'd sell CNN for $5 billion to somebody or something like that. They have no interest though, and they've made it clear they're not looking to sell anything. They have no need to. They have enough size to do what they want to do, and they have a really, really good strategy, which is to take all the discovery content, which is comfort viewing, meaning viewing that people just turn the channel on and it plays for hours and hours, like when you get into a History Channel marathon type of thing, or you put on the cooking channel and it just does cooking all day long. You know, it's just background noise. You watch some of it, whatever, it's cool. You like it. It gives you the right vibe. And that's one side of the business. Then they have the Warner Media business, which is appointment viewing, which is when you want to watch the new Sopranos episode, as I always loved to do back in the day. Or you want to watch the new Game of Thrones or whatever these freaking series are that are on now. But people seem to love these shows on the Warner Media and the HBO side. And those appointment viewing shows get people excited about the channel, and they get people talking about the channels and the shows and the service. And that's great. And then once they have people sucked in from the appointment viewing, then they can push them on, oh, but don't you also love golf? Don't you love cooking? Don't you love cars? You know, and they just can throw all this other comfort viewing at you so that in between appointments, you can get stuck watching the comfort viewing. It's an absolutely well-structured complementary business. So that's why the stock price is low. We went over the reasons. Really the number one reason is the lack of comprehension that people have, because it's so unusual that 71% of these people that own Warner Brothers Discovery were AT&T shareholders. Now, of course, they've been selling stock. I don't know what percent of them remain. It's going to probably be a year or two until most of them are sold out. If they have a big event that's a positive or negative, it'll clear out more of those AT&T shareholders. So you have more people that are serious about the company. They'll hold on to it. Berkshire Hathaway's Warren Buffett has always been very careful about who his shareholders were. When he always likes to say that, he likes the shareholders as he has. He doesn't like to split the stock. They created a smaller version of the stock at Berkshire Hathaway just so they had an opportunity to prevent other people from breaking up Berkshire Hathaway stock. But the reason they've never split Berkshire Hathaway stock is they don't want a lot of people trading in and out of the stock. They want people that'll buy the stock and hold it long term. Well, that keeps the price up, and it also keeps their relationships with investors good so that you don't have people trying to take over the company or manage the company in a different way. They have a lot of very conservative, good control at Berkshire Hathaway. They have none of that at Warner Brothers Discovery. This 71% public ownership like this with AT&T shareholders is a complete free-for-all. But it'll work itself out of the company. I don't know if it's going to take, like I said, it could be a year, it could be 3 years. But the more positive or negative events, the more it'll clear out those people, and people will come in and get out and be focused on what this company's doing. All right, so that is why the stock is so low. Happy I could do this video. If you guys have any other comments, I'd love to see them in the comments below. I really appreciate the comments. I try to respond to all of them that I can. Be sure to subscribe to the channel. Click the bell for notifications. Give me a thumbs up when you like it. And I will see you again soon with another video. And if I don't see you, I will miss you.